I'm Bob Landaas, president of Landaas Company. Just going over the reservation list for this morning's program, and I was struck by how many of you have been clients for many, many, many years. So I appreciate your coming this morning. I appreciate your loyalty, and of course, I appreciate your business. We're going to switch things up a little bit this year, take a different approach. I'm going to go back to the basics for a little bit. I've done my level best over the years to talk about interest rates and earnings as the two most important things that affect stock prices, but I thought it'd be interesting to spend a little bit of time this morning talking about how the two relate to one another and why interest rate levels are so important for stock prices, and give you folks a sense of what I think are possible and probable outcomes in the next couple of years. Going to jump into the graduate school level just for the bit and talk about the changing nature of the efficient frontiers. Sounds fancy, it's not. It's a study of at what point is the next unit of risk not worth the reward in your account. Then I'm going to discuss how to create more peace of mind in a retirement portfolio. As the markets have been fairly volatile this year, I think it's important to step back and look a little deeper into really what are the best withdrawal strategies and how best to position your portfolios in the current market conditions. Finally, I need to thank some people on my staff that have worked pretty hard to put these programs together. Thank you, Mark and Brian, for agreeing to speak this morning. Thank you, Debbie, Kyle, Ruben, Joel, Jason, and Peter. And I'd like just a round of applause for Lisa Edgar, who takes hundreds of reservations. Lisa's still talking about the round of applause you gave her last year. So thanks for the next 12 months of that. She works very hard. Thank you, Lisa. My presentation starts on page 6. I normally jump around, but I'll do my best to stick to the agenda there. So it starts on page 6 if you want to follow along. Pretty bumpy year so far. Worst start to a year in modern history. Stocks bottomed out in mid-February. Most of you were down a little over 3%. Oil hit $26 a barrel. Took the Dow down to 15.5. Stock set new records in August, took the Dow to 18.6 as oil briefly hit $50 a barrel. Markets all but ignored the vote in Great Britain. One of the more frustrating things as a money manager right now is to wrestle with the fact that oil is tied at the hip to stock prices. Never used to be like that. But oil goes up, stocks go up, oil goes down, stocks go down. Pretty difficult to predict. But we have seen now about 6 months of fairly stable oil prices, which is helping stocks. Some of you may know that 20 years ago, the developed world used the majority of the world's oil, right? The US, Europe, and Japan. It's just a mirror opposite right now. The emerging world now uses the majority of the world's oil. And the dynamics have changed dramatically. 20 years ago, if the price of oil started going down, the folks in the Middle East, they just turn the spigot down and wait for the price to go up and then start pumping again. These days, nobody wants to give up market share, so literally everybody's got the spigots turned all the way up. With the abrupt slowdown in China the last 2 years, the emerging markets took a pretty good hit. Many of them sell raw materials to China. China's not calling them as much anymore, and as a result, commodities prices have plunged. And then their use of oil along with it. So 20 years ago, it was pretty easy to predict where oil was going because the majority of it was consumed by the developed world, whose economies are fairly steady. So the emerging world drives the oil price now, and that's why demand has gone down. It's not that we're using less for the most part in the United States. We've doubled oil production in our country over the last 6 years. It's that the emerging markets are now driving the bus of oil prices becomes much more difficult to predict. Consider that from the middle of 2014 to the end of last year, middle of 14 to the end of last year, oil prices fell 60%. and the dollar rose 25%. Middle of 14, the end of last year, oil fell 60%, the dollar rose 25%. Significant headwinds to the markets. Headwinds of lower oil, in my opinion, and a stronger dollar are eventually going to fade. Since the start of this year, oil is up 30% and the dollar is down 3%. So not quite a tailwind yet. We got a ways to go on that, but the headwind is clearly dissipating. 5 quarters of negative earnings driven by a collapse in earnings of oil stocks. But there was a spillover effect. Companies like Halliburton, Schlumberger, Hughes Tool laid off tens of thousands of people in the oil patch. It hurt energy companies across the board, manufacturers, and because the dollar was so much stronger, it hurt exporters, makes it more difficult to sell your product overseas when prices are up. Earnings went negative in the third quarter of last year as oil plunged. Global economy was soft. The stronger dollar hurt U.S. exports, as I mentioned. Now here's the good news. According to the 3 major services that forecast earnings, Bloomberg, FactSet, and S&P, earnings are supposed to go up between 11 and 14% next year. So pretty good numbers. Bloomberg's my favorite. They do consensus forecasts, which in simple terms means they have 800 analysts that they ask about earnings estimates. They kick out the top 10% of the numbers, the bottom 10% of the numbers, and form what's known as a consensus forecast. Been pretty accurate. So earnings are supposed to go up 11 to 14% next year. And keep in mind the delta. So if earnings are -4 and we're supposed to go to a +7, that's an 11% change in the numbers. So more like average. A big jump because oil and the weaker dollar. And I know this sounds like an accounting gimmick, but earnings are always viewed year over year in comparisons. So the earnings that come out in the middle of October, they're comparing them to the third quarter of last year because oil stocks really started getting whacked a year ago last winter. The year over year comparisons get easier by the end of the fourth quarter. So not much of a help to the market, but no longer a drag. Stocks are a little bit overpriced at this point. But not by a whole lot. If you look at 2017 earnings for the S&P 500, consensus forecast is for $134 for the S&P. The market is now trading for 16 times next year's earnings, a little bit above average of 14.5%. Market's currently trading for 18 times this year's earnings of 117 for the S&P. We're getting through what's called confessional season. You have any bad numbers to to release, you don't wait till the end of the year. So most folks are fairly confident with the current number of 117 for the S&P. So a little bit pricey based on current levels, not so much when you look at next year. Now, as I've mentioned, over time, stock prices are primarily driven by 2 fundamental factors: interest rates and earnings. So with interest rates this low, July, the 10-year Treasury hit an all-time low of 1.36, never been lower, history of the country. And the 30-year Treasury also hit an all-time low in July. So interest rates are dragging along the bottom. So I have a hard time looking at big positions in bonds that pay 2 compared to dividends that are north of 3. Stocks are cheaper than bonds at current interest rates. I think it needs to be said that the market knows that rates are going up. I'm assuming that everybody in this room knows that at some point the Fed's going to continue to increase interest rates. There's no surprise there. The expression, it's baked into the cake. The markets clearly know that rates are going up, and I believe they fully reflect the fact that short-term rates are going up. So on a technical basis, the S&P 500 has a dividend yield of 2.1%. And recently, the other day at the close, the 10-year Treasury was selling to yield 1.6%. So the stocks are paying a higher dividend than the 10-year. I'm about to start my 42nd year of money management professionally. For the first quarter of my career, dividends were always higher than interest payments. because it was widely assumed that stocks were riskier than bonds, so you'd want a higher income stream from the dividends than the bonds themselves. And we're going back to those days at this point in time. Janet Yellen in Wyoming a couple weeks ago made it pretty clear that everybody needs to expect interest rates to stay lower for longer than most people think. Leading the list this year, as I mentioned, have been the high dividend stocks. Companies like AT&T, Verizon, Johnson & Johnson, the utilities have done really well. Pretty unusual for the value stocks to lead the markets, but I suspect a lot of it is due to the fact that we got off to such a terrible start that investors started migrating towards the safer names. So the last point is earnings yields are much higher than bond yields. And I've gone over this in the past. I assume some folks know what this is, but start off with the PE ratio, right? If we go to next year's earnings, the market is selling for 16 times $1 of earnings. PEs are central to everyone understanding stock prices. Historically, investors have paid 15.5 times $1 of earnings. Right? When you buy a stock, all you're doing is getting a piece of the earnings. You want to know what your piece is and how much you have to pay for $1 of earnings. So if you turn a PE on its head, the reciprocal of a PE of 16 is 6.25. So another way to tell you the same story is if you take $1 out of your pocket, you'll get 6.25 cents of earnings off the average stock. Okay, 6.25 with a PE of 16. We're just talking about the reciprocal of a PE of 16. So again, compare and contrast that 6.25 cents of earnings off your dollar with 1.6 cents of interest off the 10-year Treasury. A couple things I'm going to require you to remember in this program this morning. The second thing is 6.25 is a bigger number than 1.6. So when you look at the slide that's coming up, you see the gap. It's widening. And again, the market knows that rates are going up, so they know the short end is coming up, right? It's baked into the equation. But historically, when the spreads are really wide between earnings yields and bond yields, it serves as fundamental support for stock prices. We've been talking about this one for a couple of years. Companies are flush with cash. Problem is, we want companies to grow organically. We want companies to grow their businesses. And what companies are doing instead is, okay, it's not my top pick. All day long, my top pick for the use of cash that companies have is to grow their companies organically. My second pick is a dividend. You know, you guys can't figure out what to do with the money, send it to me as a dividend, I'll figure out what to do with it. And my third is stock buybacks. Stock buybacks, of course, reduce the number of shares outstanding on the street, and as a result increases per share earnings, and is a pretty easy, quick way to juice your earnings per share as a company. Doesn't really grow your operation, doesn't really help me as a shareholder longer term. I'm looking for steady, reliable, dependable cash flow that's capable of growing. You're not going to grow your cash flow by buying back your company stock. But regardless, companies are paying more in dividends. Consider my second point here that dividends, this is a big number now, have gone up 10.5% a year, each year now for the last 5 years. And that's all driven by how much cash corporations are sitting on in the United States. They can't grow organically, is the expression, so they have to do other things with their cash. But for most of you that are dependent upon your savings for retirement income, the fact that dividends are going up over 10% a year for the last 5 years is a huge number, no matter how you look at it. All right, here we go to the graduate school level just for a minute. If I'm going to buy a company, I'm going to try to forecast their earnings as far as I can into the future, and then discount that income stream by an interest rate to determine current value. Right? The basic way to analyze a company. Look as far as I can into the future to predict their earnings, discount it by an interest rate to get the current value. So the point is simple. If interest rates are low, I discount that cash flow by a lower interest rate resulting in a higher value for the company. Got it? Just the opposite applies. If interest rates are higher, I'm then forced to use a higher interest rate to discount that future cash flow, resulting in a lower value for the company. So as interest rates stayed low for a longer period of time, people like us that do our level best to value markets notice time and time and time again that the discount mechanism has stayed very low for a very long period of time, again, helping to support stock prices. Two of the better videos that we ever produced on this subject were done by Brian Kill. The most recent one is going to be attached to our newsletter that comes out at the end of the month. For those of you that don't get our newsletter, get it. It's highly educational. It's free. We don't bore you with trivial stuff. We really try to focus on, what's on our minds. What are we currently thinking about? I frankly thought Brian did a wonderful job. He did another one a couple years back. Brian, a CPA by training, Price Waterhouse, and gets the valuation concept. So if you want to go a little bit deeper on this subject, go to the website. You'll see both the videos. You don't get the newsletter. Get it. It's a lot of people read it, widely circulated, and you certainly can't beat the price. So this next slide just clearly shows earnings yields versus bond yields. The dotted line, the top right side, is the earnings yield for the market. This just goes through the end of last year, so it shows an earnings yield on the market with a PE of 18. 12-month trailing earnings gives you an earnings yield of 5.5%. And then on the bottom, you can see that the 10-year Treasury yield is at 1.6%. But other than the spread that you saw in the financial crisis, the gap is really high. Abby Joseph Cohen used to be the head of economic research, Goldman Sachs. She made famous in the 90s the concept that the market could support much higher multiples, much higher PEs in a low inflation, low interest rate environment. And I marvel that interest rates are considerably lower when she made that comment, and inflation is barely measurable. So you want to keep your eye on the earnings yield versus the bond yield. It's not perfect, but it does give you a sense of valuations. It gives you a better sense of probably where we're going in the markets. Okay, so those of you that are wondering why you probably came close to breaking even in 2015, here's your answer. Earnings were flat as a pancake. 1 out of 10 stocks is an oil stock. 1 out of 5 stocks is either an insurance company, a bank, or a property and casualty company. So you had almost a third of the market that was struggling. So there was basically no increase in earnings this last year. Right? Markets are driven by interest rates and earnings. So keep your eye on the prize. Look at next year. Big jump, folks. 2017, $134 and some change. Let alone the year after next. Gets a little fuzzy going out a couple years on this. But again, they're talking about a 10.1% consensus forecast. We're not cherry picking the highest numbers here. We're showing you consensus numbers. Pretty good range between 11 and 14%. Next point I need to make very clear is that short term, there's all sorts of things that can drive stock markets, all sorts of things. Longer term, they know that it's only interest rates and earnings. So me standing up here and telling you folks that earnings are supposed to go up to $134 next year for the S&P doesn't mean the market's going to necessarily reflect that next year. Longer term, there's a dead-on parallel to it. But it's kind of frustrating in our business that earnings shoot up over 10 doesn't mean stocks are going to go up 10. One of my guesses now is the market's already looking into next year, and some of the underlying strength you're seeing is because earnings are supposed to do well for next year. So I don't want you walking out of here thinking that your accounts are going up over 10 next year. But the news is certainly encouraging on an earnings front for not just next year, but the year after next. Just as an aside, I got a question just before the seminar. Bob, GDP is not growing much. How can profits go up 11 to 14%? One of the answers is margins. They're almost at record levels. 10 cents on the dollar is profit now in corporate America. And another is the share buybacks. It's a big deal, folks. It's added almost 3% to per share earnings over the last couple of years. So just between the buybacks and the dividend plays explains a lot of what's going on in the street. So what you want to do on this chart is to go back to 1980, kind of the middle of the page. I bring this chart out every other year or so. The short version of this story is that there's a dead-on parallel over the last 30 years between increase in profits and increase in stock prices. It's right on the money. Normally we're used to paying 15 times $1 of earnings, and as those earnings go up, stocks eventually follow. And it's not perfect. You can see on the right-hand side, profits jumped ahead of stock prices for a while, then it went the other way. But it's pretty darn close. So that's how stocks work. Short term, I'm amazed by how many people call me and worry about this thing or the other. And, a lot of it is legitimate. There are all sorts of things that can buffet the stock market short term. But longer term, it's all about the money. It's all about earnings and knowing that longer term, we know that stocks are going to do 7% a year plus the inflation rate. Talk a little bit about interest rates. As a guy that does this for a living, I'm pretty amused by the fact that the media seems obsessed about the when of interest rate increases. Guys like us are more concerned with what the goal line looks like. A couple of years ago, it was widely thought that the Fed would raise the short-term rate, the overnight rate, to as high as 4%. Nobody thinks that anymore. The consensus is give or take about 2.5%. So folks, what we're talking about here is there's 6 quarter-point rate increases that won't happen. Furthermore, we started this year with it being widely understood that the Fed was going to raise short-term rates 4 times this year, right? So here it is, heading towards October. They haven't raised once this year. So keep your eye on the goal line, not necessarily the when of it. I highly doubt, although I'm at risk at this, they're going to announce Milwaukee time a little after 1:30 this afternoon as to what they've decided. So here's my daring act of clairvoyance. They're not going to raise this afternoon. But they'll probably raise in December. But the target's changed, and that's a big deal from earlier in the year. Now, my last point is probably the most interesting. When the Fed raised this last December, look at my hands now, this intermediate rates, here's short rates. When the Fed raised last December, the short rate went up, but the intermediate and long-term bond yields fell. Sounds counterintuitive, doesn't it? We had all talked to a bond manager in October of last year. Big shot from Boston was telling us that he just spent $140 million buying a 30-year treasury. Our mouths dropped. Everybody knew we were on the cusp of a rate increase. 140 million strikes me as a pretty gutsy bet, right? On a 30-year treasury, he made 11% in 2 weeks. Nice, huh? 140 million, that's a nice return. Obviously, it could have gone the other way, but it gives you a sense of what the street thinks. There is no measurable inflation out there. They can barely measure it. I have a chart I'll show you in a minute. Inflation has been going down every year for the last 5 years. The Fed's target is 2%. They can't even get it close. So when the Fed raises the overnight rate, please remember that the Fed only controls short-term interest rates. Wall Street, collectively, based on our outlook for inflation, controls everything else. So I found it really curious that interest rates fell on the intermediate end, and we all did really well on our bonds this year, right? How cool is that? And it was not expected. So interest rates went up on the short end, bonds fell on the intermediate and the long end. Now, for the last 5 years, I've been told by all sorts of people that interest rates and inflation had to go up. And I kept saying, now hold it. What if Just what if interest rates come down and stay down? And darned if that's not what's happened. So all of you have been reading in the popular press now for years that bonds are going to get shellacked, that interest rates and inflation have nowhere to go but up, and bonds are the next bubble. So I found it very curious that yields went to record lows in July. Just the mirror opposite of what you all have been told. So I like bonds for all sorts of reasons, but interest rates aren't going to go down anymore. They can't. So it requires a different strategy in the fixed income markets. When the Fed raises rates, what you really want to worry about is inflation. Going into 42 years of doing this, I can tell you what my life is like. Halfway through a recovery, I become obsessed with inflation. 8 out of the last 10 recessions have been caused by the Fed raising interest rates to reduce inflation. They put the hammer down on the economy and we go into recession. 8 out of the last 10. So I tend to obsess about every little economic indicator I can get my hands on. My personal favorite is the personal consumption expenditure index buried inside the GDP report. That's the Fed's favorite gauge of inflation. And as I show on the slide, inflation's gone down from 1.9 to 1.6 to 1.5 to 1.1. So here's why I'm telling you this. What you really worry about is the Fed raising rates because they're freaked out about inflation. And that's not what's happening now. What the Fed's doing is resetting monetary policy. They're trying to get it a little bit higher than it is. One of the concerns that the Fed's expressed this year is that in the last 4 recessions, the Fed has lowered short-term rates on average 500 basis points or 5%. So folks, figure this out, right? We're at a half now. So they got clearly 1, maybe 2 arms tied behind their back should we enter the next recession with interest rates at such a low level. So last 4 recessions, the Fed lowered the overnight rate by 5%, 500 basis points. They clearly don't have that ability to do that at this point in time. So I'm not as worried about the Fed now. It's interesting, in most of my client meetings, that bond worries come right out near the top of the list. You have way more to worry about with stocks than bonds. And I think this year kind of proves that. So the pros are forecasting moderate to modest growth next year, 2.5%, could be higher. Matches the growth of the economy in the United States for the last 7 years. So moderate to modest growth. Clearly what's driving our economy is the consumer. Housing, consumer spending have been contributing to economic growth. Business spending is weak, but they're taking their cash and buying back their shares and paying us higher dividends. The weakness clearly has been in manufacturing, industrial businesses, energy, and exports. Corporations, as I mentioned just a bit ago, are enjoying strong profit margins. They're down just a tad from the records that we had last year, but give or take almost 10 cents on the dollar is profit. Normally halfway through the business cycle, margins get squeezed because you're paying more for labor, you're paying more for raw materials, and it costs more to add capacity to your operation. So typically margins get squeezed halfway through the cycle. None of that's happening now. Still plenty of people out of work. Margins are staying strong because commodities prices, frankly, have plunged over the last 3 years, and there's plenty of capacity out there. Consider that over the last 2 years, the United States economy has added 5 million new jobs. We've seen a significant pickup in personal income and savings. A week ago Monday, y'all saw in the paper that personal income rose 5.2% last year, the highest since they started keeping record in the 60s. One of my favorite data points about consumer spending is from June of last year to June of this year, Americans saved $3.6 billion because of lower gasoline prices, then turned around and spent $2.5 billion more at bars and restaurants. So I guess collectively we know how to put those savings to good use. Going Go to any restaurant in Milwaukee, you normally have to wait in line on the weekends. You get a pretty good sense of the health of the consumer at this point in time. Briefly touched on the third bullet point there, the net drag of a stronger dollar. Big deal, folks. Dollar's gone up a lot last 4 years, starting to come down. And the drag of lower oil prices will likely dissipate, as I mentioned. Be a while before it becomes a tailwind, but it's not quite the headwind that we've seen. To be fair, I got to talk about a couple of potential negatives. First one that leads the list is productivity growth. This one's easy to explain. We're talking about output per man-hour worked. How many units can you produce per hour? And it's very flat now. Furthermore, the economists can't really even explain it. They don't really know why productivity growth is so low. But it's the only way to increase aggregate net worth. Only way possible is to produce more of something per hour, so the company makes more, employees make more, and everybody's happy at the end of the year. Only way to increase aggregate net worth is to increase productivity, and it's flat as a pancake. In the 90s, we saw productivity growth over 3% a year. That's a lot. So that's something to keep your eye on. The other is the labor force participation rate. It's low. They measure from 18 to 64 people in the workforce. It's down to 63% now. Just a handful of years ago, it was up to 67%. You need more worker bees to produce more work so that there's higher earnings and higher share prices. Pretty much that simple. But the labor force participation rate down to 63%. And this one's across all ages. You would think it'd be retiring boomers, hanging it up because there's so many of us, that it would impact workforce participation rates, labor rates. But it's true for people in their 20s, their 30s, their 40s, their 50s. So those are two things that are holding back the economy a little bit, but at the end of the day, I'm pretty upbeat for next year. So the forecast is modest to moderate growth. Consumer is doing much better, and of course drives over 70% of the economy. So in spite of what some folks want to tell you otherwise, the U.S. economy has never been larger. Take a look at the far right-hand side of that chart. GDP is going to be about $16.7 trillion this year. Look at the height of GDP just prior to the financial crisis, and we were a tad under 15 trillion. Start talking about big numbers when you get into the trillions. The economy is 10% larger than it was at the peak just prior to the financial crisis. So the U.S. economy has never been larger. This next one's kind of a pet peeve of mine. Most of you probably know that Wisconsin trades places with Indiana every other year or so, with the highest number of jobs tied to manufacturing in America. RV sales started to pick up a couple years ago, so Indiana regained first place. With the number of jobs tied to manufacturing, Wisconsin still remains number 2. But what I find so curious is if you look at the dotted line, upper right-hand side, that's industrial production. Give or take, it's the highest it's ever been. A lot of people that I talk to think that manufacturing output in the United States has plunged over the years. No, it hasn't. It's almost the highest it's ever been. What is different is employment levels in manufacturing. And we're talking about U.S. production here, so it's not jobs that went to maquiladora operations in Mexico or got outsourced to China. We're talking about the United States here. So what a lot of people miss is that a lot of jobs got computerized. Right? They didn't get outsourced. They didn't get sent to China. They got computerized, where somebody does the work of 15 or 20 or more people compared to the old days. So I think it's important to focus on the absolute dollars of production that, give or take, they're about the highest they've ever been, but yes, at the expense of employment. Now, speaking of employment, this shows you private payrolls. We're not talking about government jobs here. Non-farm private payrolls, these are the ones they announce first Friday of every month. You can see on the left-hand hump, if you will, was at the peak just prior to the financial crisis. Give or take, there are about 116 million people working in the private sector in '07. Right, so we lost almost 9 million jobs. That's a lot. But not only did we recover those 9 million jobs, but we added another 7 million. So if you look at the far right side of the chart, give or take, there are about 123 million Americans working in the private sector. So not only did we fully recover the jobs lost in the financial crisis, but we added quite a few jobs above and beyond that. So a real curious thing that's going on in America right now is that the savings rate continues to go up. Historically, when interest rates go down, people quit saving as much. The concept's simple: hey, what am I doing saving money? Interest rates are so low. But what's so interesting now in this country is that the savings rate continues to go up even though interest rates go down. It doesn't normally work that way. Economists can talk about the paradox of thrift. That one's easy to explain. We're talking about how short-term economists would rather you all spend your money instead of saving it. Gives the economy a boost. So the paradox of thrift is long-term, it's a good thing that everybody's improving their savings and their balance sheets. The bad news short-term is it can tend to hold back consumer spending. But what's so curious now is that it's not. Right? Retail sales were up 4.2% in the second quarter. That's a big number. So you take a look at this chart, the dotted line on the right is aggregate net worth. Big number, this is measured in trillions. So aggregate net worth of Americans is almost $90 trillion, big number. What's even more impressive is the debt service. So on the screen, that's the orange line. And we're talking about, of your disposable income, how much goes to debt service, right? So the 30-year average is 11.5. We're significantly below the 30-year average with disposable income that goes to debt service. So the short version of that story is people have some buying power in reserve. 70% of our economy is, of course, driven by the consumer, and that's what's driving this economy by far at this point. So I'm going to shift gears, talk internationally just for a bit. China's economy is slowing, affecting the emerging markets. This one's easy to explain. China uses the majority of commodities in the world, and that number's dropping. So if you're digging iron ore out of the ground in Brazil, sending it to China, you dig copper out of the ground in Chile, send it to China. The Chinese aren't calling you as much, right? Because their economy continues to shrink. So it had a big impact on the emerging markets that are driven by natural resource extraction. Commodities prices and their currencies have been affected. So the more an emerging market digs raw materials out of the ground, the more they've suffered compared to India. India doesn't do a lot of mineral extraction, and as a result, their economies have held up better. But it's directly affected by the slowdown in China. The Fed, for most of this year, said that my last bullet point was why they didn't raise rates. Jim, let me pick on you. You have a company in Malaysia and you make whatever they make in Malaysia. So since the financial crisis, the Malaysian banks weren't eager to lend you in local currency, and they'd lend you dollars, right? So that works out good till it doesn't. And when your currency dropped 20% against the US dollar, boy, there's strike one. So if you borrowed $1 million, all of a sudden you owe $1.2 million effectively. Now, strike number two is whatever it is you're making in Malaysia, you're probably sending it to China, and they're not calling you as much. So not only did your loan balance effectively get marked up by the percentage drop of your currency, but your business is struggling now. So the Fed, for most of this year, gave that as one of the technical reasons for not raising interest rates in the United States. They were worried about dollar-denominated foreign debt weighing on the markets. I can't remember a time that the Fed is giving investors so much of advance notice in raising interest rates. Can't even remember. I mean, think back to 1994, Alan Greenspan blindsided the street, no notice, raised interest rates 7 times, right? No notice at all. He thought it was none of our business for some reason. So now they go out of the way to be transparent, and most of us are, hey, all right, let's just get it over with, raise rates. I'm sick of talking about it. But it's one of the reasons why they said that they weren't in a hurry to raise, because of this dollar-denominated debt overseas, very different than before the financial crisis. So as I've mentioned, the dollar has been real strong over the last 4 years. Gets tougher if you're selling product overseas. Your product gets more expensive by the increase in the currency, and it has affected exports. Should change over the next few years. We have what's known as divergent monetary policy worldwide. This one's easy to talk about. We're in the process of raising interest rates in the U.S. Everybody else is in the process of lowering rates. So we win on that transaction. Money pours into the United States because we have some of the highest yields of sovereign debt worldwide of any of the developed nations. So as the rest of the world, the European Central Bank, Bank of Japan, Bank of China, lowers rates, and we're proceed to be in the process of raising rates, makes the dollar more attractive. But here's the point. Within a year or so, it'll be widely perceived that we're almost done raising rates. And when that happens, the dollar has to start to weaken. And I can't wait for that to happen. Valuations are a lot less expensive overseas. Demographic growth drives economic growth. I'll get that in a bit. I'm just chomping at the bit, but I keep worrying about the dollar. And you get a workaround on that with emerging markets. Some of them peg their currency to the dollar, so I take out currency risk on that trade. But I'm chomping at the bit. We've been underweight international for a while, thank goodness. But I suspect that's going to change, and I think it's going to be one of the best buying opportunities. In our business, being early is the same as being wrong. So I think we got a ways to go yet till we get to the point where everybody understands that, yeah, the Fed is done, and perhaps the Europeans get away from the lunacy of negative interest rates. So growth in the developed world outside of the U.S. is sluggish. Japan just went negative. Europe is flat as a pancake, just slightly positive. My opinion, negative interest rates are doing more harm than good now. The concept, I get asked this a lot, Bob, it doesn't make any sense to me. Explain why I'd ever give people money where they give me less back in the future. But the concept's easy to explain initially, then it gets kind of wild. Negative rates were intended to force companies to spend money. Get it off your balance sheet, spend the money, expand your operation. Negative interest rates were further intended to encourage banks to lend. So they got charged to park their money overnight at the European Central Bank. Then the European Central Bank said, hey, we're going to start charging you a lot for this. So start lending it out. Don't be parking it. And this leads me to my next point, which is I was a big fan of monetary easing in the beginning. It clearly was what pulled us out of the Great Recession, but the effects started to fade. So TARP worked really well in the United States. QE1 was very effective. QE2 was. But by the time we got to the third round of quantitative easing, known as QE3, not so much. So I'm hoping that they raise interest rates to give us a little bit higher rate on our savings. Seems like so long ago. But I always thought 4% on a money market fund was the average that we would always enjoy. And now it's down to 0. Brexit's a problem for the United Kingdom. Impact on the United States should be limited. Literally within 24 hours of the vote, the third week in June, I wrote an article for the website, talked at length what I thought about the vote. I wasn't in favor of them leaving. I think the European Union's got all sorts of problems, primarily monetary policy. Pretty hard to get the Southern Europeans to agree that inflation is not a problem. Pretty hard to convince the Northern Europeans, particularly Germany, to ignore inflation. And I think it's difficult for 30 countries to agree on one monetary policy. So I think they have real problems on their hands, but I don't see United Kingdom being a winner leaving the European Union. But if you want to go deep on Brexit, look at the website, and I'll give you a little bit more detail on some of my thoughts there. The markets basically ignored Brexit. We dropped initially, but within a pretty short period of time, the U.S. markets kind of ignored it. So this chart shows why I've been underweight, particularly the emerging markets. This goes back to the end of 2012. Top line is developed markets, right? So the U.S., Europe, and Japan up collectively over 38% since the beginning of 13. You look at the blue line, even though some of the emerging market debt has rallied this year, emerging market stock, according to the Morgan Stanley Capital International Index, emerging markets are still underwater by 6.6%. So it's a lot, and they got a ways to go. Unfortunately, so many of the emerging economies are directly tied to the health of China. China slows, and they inevitably slow as well. I've pretty much beat this point to death, so I'll make this quick. Talks about the dollar relative to the yen, the euro, basket of currencies. Dollar peaked last in 2000. Last time this country had a surplus. We started developing deficits in 2001, and we've been going at it pretty strong ever since. But this shows you the strength of the dollar. It gives you a sense of the headwinds, and the good news is the dollar is weakening just a tad, but enough to take the pressure off. So here's the simple point of this chart. In the last 65 years, every global recession started in the United States. No exceptions. So for the last 65 years, there's never been a recession in America that started outside our shores. It's never happened, 65 years. The next time, I think it could be different. And here's why. The Chinese economy for the better part of 30 years has been based on building infrastructure. And the concept's easy to explain. The marginal return on equity, which in English means the first freeway you build, you get a pretty good bang for your buck. The 100th, not so much. So China has been driving their export economy and building a lot of infrastructure. And the marginal return on equity keeps doing this. So what they need to do is shift to a consumer-based economy. I talked a little bit about this last year, and it's not going so good, right? Just keep this brief. There's never been a case of an autocracy in the history of the world building a middle class. It's never happened. You need two things, folks: freedom of speech and freedom of assembly. And we get those two concepts really well here in this country. But China doesn't get that, right? Now, just for fun, the next time you're at a cocktail party, ask somebody to identify just one consumer brand from China. The closest I ever get is people say Sing Ta, the beer, but it's actually from Thailand. That's the only guess I get. We invented consumerism. Nobody's better than Americans at consumerism, right? So the old industrial model in China is not working like it used to. China, per capita income-wise, is at about $8,000 per person. It's where Japan was in the early 70s, where Taiwan was in the early 80s, and where South Korea was in the early 90s. And in every single case, they built enormous middle classes and transitioned away from an export-driven economy to one of consumption. It's the only way it works. And China's struggling. Here's another point. The growth in the working age population in China went negative last year, right? So what I just told you is they got fewer worker bees entering the workforce because they decided way back when on that one-child policy, right? And now it's haunting them. Wages in China have been doing this the last 3-4 years. More and more manufacturers are going to Vietnam, to Malaysia, to other places in Asia to get the work done less expensively. So the Chinese model is shifting. Now, before I totally bum you out on this, China has the one thing that we don't have, which is control of their currency. They have the ability to continue to devalue their currency and flood our Costco's and Walmarts and Sam's Clubs with their cheap goods. But there's only so far they can go with that, because they're not the only ones playing that card. You've got Malaysia and Vietnam and others that are trying to devalue their currency to compete with the Chinese for inexpensive exports. So as I said, in the last 65 years, we've never had a downturn in America that started overseas. Next time around, it could be different, and this has to top my list of worries. But as I mentioned a bit ago, I'm chomping at the bit. Here's why. You look at values overseas, one of the basic lessons I learned when I started this in '75 was try to get a deal on whatever you buy. It was pretty good advice when I got told that. It may stay a deal, it may become a better deal, but it is hard to look stupid if you try to get a deal on what you bought. So if you look at the valuations overseas, pretty compelling story, folks. You look at the Europe, Australasia, Far East Index, the IFA, you got a forward PE of 14, right, compared to the US at 16. You got a dividend yield for the IFA at 3.5, compare that to 2.1 here in the United States. You step up to the emerging markets, and now you're really starting to talk about significant value. Forward PE at 12, again, compare and contrast that to us at 16. You got a dividend yield 2.7, a little bit lower because they're growing faster. They don't pay big dividends. They like to grow. And then I've got a forward PE for the U.S. at 16.9. This chart was dated in June of this past year, which is why the numbers are a little bit different. So the global valuations are pretty compelling. Can't quite get in yet because you got to wait for the dollar to settle down some. 3% isn't enough to convince me that it's time. So the last chart I have internationally tells you the whole story in a nutshell. The data point that I used for the last 2 years came from the World Bank, where they estimated that the middle class was going to triple between now and 2030. Triple. They estimate, give or take, about 800 million people in the middle class worldwide out of a population of, give or take, a little north of 7 billion people. So look at the middle of that chart, right? It just jumps out at you. So this tells you a little bit different. This talks about middle class consumption by 2030. None of the growth's coming from the US, Europe, or Japan. It's all coming from Asia. 558% increase in consumption within a fairly short period of time. So it's a big number. This will be the payback to America with globalization. We lead the world in the top consumer brands. We dominate technology, we dominate entertainment, we dominate education, we dominate healthcare. You pick a subject, we dominate it. We invented the game. Everybody wants to live like us, look like us, have houses like us, have our access to healthcare, have our access to education, on and on and on and on. U.S. dominates consumer brands, but the growth is going to be from overseas. One of the reasons why I continue to insist on investing in large multinationals domiciled in the United States that do quite a bit of business overseas. So this is yet another year where I get to stand up here and say that the best selling car in China is a Buick, right? Folks, that's 4 years in a row that the Buick is the best selling car in China. Isn't that a great story? All right, now I'm going to shift gears here, talk about the efficient frontiers. This point's kind of important. In the 1950s, a guy named Harry Markowitz, teaching down at the University of Chicago, started studying asset allocation. What drives performance in your account? By 1990, Professor Markowitz was awarded the Nobel Prize in Economics for his theory that asset allocation drives 92% of how well you do. And the other 8% is market timing and stock selection. So it's not that stock selection and market timing don't matter, but they don't really amount to a hill of beans compared to the 92% that really matters was asset allocation. Now here's why I'm telling you this. For a good part of my career, I was convinced that the academic studies were accurate, that you should have 55% in stock. Those are back in the days when I thought it was my birthright to make 5% every year on bonds. So when you do efficient frontier models, at what point is the next unit of risk not worth the reward? You're back testing against a backdrop of declining interest rates. So moving forward, as we continue to analyze efficient frontiers, it's not that the data is unreliable, it's that it's not repeatable. Okay, interest rates started going down in 1980, and for the better part of 35 years have been doing this. Y'all know interest rates go down, bonds do good, and those days are behind us. So if you look at the chart there when you get home, kind of hard to see. I mean, that explains it in English. A 40% in stock, 60% in bonds would have returned 8.9% the last 30 years. If you go to 100% in stock, you only made 1.5% more on your money for 2 times the risk, right? So you're not getting paid enough for all of this stuff. So that's the simple concept of efficient frontiers. Now here's why I'm telling you all this. We're reasonably convinced that the new model is closer to 60%. As a firm, collectively, we're all at about 60% in stocks, 40% in bonds, right? So we think it's moving closer to 60%. It's important to pay attention to your betas, right? We report those every month, the second page of your Morningstar reports. You want to make sure your betas don't start jumping. So beta is simple to explain. They assign the number 1 to the S&P 500. If you have close to 1 for a beta, you have average risk. Now we pay pretty close attention to this. Most of you don't have betas much past 1.1. So the incremental increase should be in the value end of the market that Mark's going to be talking about here in a minute. But we think low interest rates are going to stay with us for a while. I know of all sorts of dividend plays where I'll get a higher dividend than what the interest payment's going to be on the bond. Hopefully, with any amount of luck and a fair wind, my dividend's going to grow. That interest payment can't grow. And again, I'm comparing apples to orangutans here. Bonds are nice and safe, stocks aren't. But we think most people are going to be better served by heading a little bit higher. And of course, we don't do model investing. Everybody gets a custom suit of clothing. So it depends upon your suitability guidelines and standards. But here's the important point. If you consider 60% in stocks and assume that instead of the 10.5% average that stocks have enjoyed, that you're going to bring it down to 8%. So you got 8% on 60% of your money. We're further assuming, these are guesses, educated guesses, that you're going to average 3% on your fixed income. So you shake all that together, that's 6% on your money. So we think with a 6% return that it could clearly support a 4% withdrawal and allow for a 2% reinvestment for inflation. But here's why I'm telling you this. Try to take the worry out of your investing. The problem that we all face is that when the market goes down, the average person thinks it's going to last for an eternity. Now, I've been at this forever, right? By February, I was fed up. The market had only been going down 9 weeks, right? And I had it up to here. And I've been professionally trained to ignore that stuff. So when you're in the middle of the sell-off, you think, oh my God, this is never going to stop. I've had it. All right, it goes down a little further, you're more inclined to throw in the towel. But here's the good news. On average, it takes less than 2 years for markets to recover. So what I'm talking about is from the peak to the trough, back to the prior peak, takes a little less than 2 years. Financial crisis, even if you were all in, took less than 4.5 years. So the point of having 40% in bonds with a 4% withdrawal rate is that if things go to hell in a handbasket, I've got 10 years of payments where I'm drop dead positive where the money's coming from. Long past the period it normally takes stocks to recover. That's the best part of the story. Have 10 years of staying power, so no ifs, ands, doubts, or buts you have enough money to last you 10 years. And it flat out doesn't take 10 years. It takes on average of just less than 2 years. Furthermore, consider that the total return of stocks and the total return of bonds have never been negative in the same year for the last 40 years. So I'm always going to have something to point at in the portfolio that's got its head above water. Right? Again, the total return of stocks and the total return of bonds have not been negative in the same year at any time for the last 40 years. This is kind of a fun chart. It shows you the financial crisis. This one's going to be a little bit hard to read in your handouts, but here's the punchline. If you had 60% in stocks, 40% in bonds, the worst sell-off in modern history, it took you 3 years and 2 months to recover. 3 years, 2 months from the worst sell-off in modern history. If you were all in, as I mentioned, it took you 4.5 years. So even with that kind of shellacking, right, having 40% of your money in bonds, more than enough to tide you over to let the prices come back. So I'd like to bring up Mark Amateus at this point to talk about value investing. Then Brian will come up, and then time permitting, I'll host a brief Q&A. Thank you.